Hello everyone, welcome again to this channel, Hybrid Accounts. And today, if you haven't subscribed, you can subscribe so as to obtain regular updates. All right, today we're just going to take a look at a new standard called I-37, Statement of Cash Flows. Actually, a statement of cash flows is among the components of financial statements. It is usually presented alongside a statement of profit or loss and other comprehensive income, statement of financial position, statement of changes in equity, and note to the financial statements. And so we usually include statement of cash flows. Why do we usually include statement of cash flows before going to anything else? The financial statements are prepared on an accrual basis, and accrual basis means that revenue is recognized when earned, regardless of whether cash has been received or not, but also expenses are recognized when incurred, regardless of whether actually cash has been paid or not. So this is what we do. So usually the normal basis of preparation of account is accrual basis, accrual basis. So since we use the accrual basis, it goes to show us that there won't be a clear vision of the cash position of the entity. We'll just be having the cash at the beginning and the cash at the end of the period. And so by using the statement of cash flows, actually we take a look at several activities that take place in the entity and show the cash, actually the cash surplus or the cash deficit for several activities. And that's why you say the aim of I-7 is to provide information to users of financial statements about the entities. Now take a look here. Entities' ability to generate cash and cash equivalents. Entities' ability to generate cash and cash equivalents. Actually, take a look at that later, but this is what we are going to concentrate on. We have cash. We'll take a look later on the meaning of cash as well as on the meaning of cash equivalent. Don't worry about that at all. As well as indicating the cash needs of the entity. So actually, how the entity generates cash, you can obtain that from operating activities. When you operate, how much cash do you generate? But also in investing, actually, you can invest and earn some cash and obtain some cash. But in financing, we can say it can show the cash needs of the entity, how much cash the entity needs. So we'll take a look at that later. But as for now, all you need to know is that when dealing with the statement of cash flows, actually we separate the cash flows into three main activities. So it provides historical information about cash and cash equivalents, classifying cash flows between operating activities, investing activities, as well as financing activities. So these are the three major activities when preparing the statement of cash flows, as we'll see in the example later. So let's just proceed with the standard and we'll take a look at what operating activities mean, investing activities mean, as well as financing activities mean. But I could just go directly and tell you that when speaking of operating activities, we just refer to principal revenue generating activities. Let's say you're doing a business of selling shoes. The money you obtain from selling shoes, that's what we call revenue. All right. We also have investing activities. When speaking of investing activities, we usually refer to the acquisition and disposal of non-current assets, just like that. We'll take a look at that too. And then we have financing activities. Financing activities refer to everything that changes the capital structure of the entity, or the amount of that of those sources of finance, which are usually long-term sources of finance. And so we can just go to the scope here. Here we are at the scope. By how much should we use the statement of cash flows? Is it limited or not? So we say a statement of cash flows should be presented as an integral part of the entity's financial statements, as I just spoke them out. I said statement of profit or loss and the other comprehensive income, statement of financial position, statement of changes in equity, and then not the financial statements. So statement of cash flows will also be presented along those statements. And so we say all entities using IFRS are required by the standard to produce a statement of cash flows. All entities. If the entity has adopted IFRS, and so it has to produce a statement of cash flows too. So that's what we do. All right, let's just go and take a look at benefits of cash flow information. How does cash flow information help us? First of all, statement of cash flows enhance comparability. This is a very, very important point. How do we mean by saying it enhances comparability? You know, the cash flows are not affected. They are not affected by accounting policies. You change the accounting policies, cash is the same. But you know, as opposed to profit, if you change accounting policies, if you let's say one company is using FIFO method of valuing inventory, and the other company using AVICO method of valuing inventories, comparability becomes very difficult because you would have different values of inventories and so different values of cost of sales. But if for cash flows, this won't be the case. So it won't be affected by the differing accounting policies. But also I could add here, cash flows are less subject to manipulation. You know, things like profit, someone can just change accounting policies, or maybe someone can just be using the depreciation method that actually charges depreciation at a slower rate. And so comparability becomes very difficult when comparing different companies. So simply speaking, cash flows enhances comparability. But also we say that cash flow information of a historical nature can be used as an indicator of the amount, timing, and certainty of future cash flows. So it can indicate amount, timing, and certainty of future cash flows, while past cash flow information can be checked for accuracy as actual figures emerge. You can just check that. But also I could say that it can be used in valuing the business. It can be used in business valuation. How can I use it in valuing the business? You know, by checking the past trends of the cash flows and going further into the future, you can use past cash flows to project the future cash flows and then use methods like finance method like free cash flows to equity. This is free, not free cash flows to equity or free cash flow to the firm, so as to value the business. Actually, we usually take the future cash flows, we discount them at an appropriate discount rate and obtain the value of the business. So we can do that. All right, we can proceed now. Let's go to further definitions here. Now we're just getting deeper and deeper into the standard. Now let's take a look here. Definitions. What is cash? We just spoke of cash and cash equivalents. What do we mean by the term cash? By cash, we simply mean cash on hand and demand deposits, like cash at bank. So that's what we mean by cash. By cash, we mean cash on hand and cash that we can have in our hands at any time we want, although currently it isn't in our hands. For example, cash at bank. You just go at the bank, you take that cash. That's what we call cash. But also we have cash equivalents. What do we mean by cash equivalent? So cash equivalent is not cash, but it is close to cash, and that's why we call it cash equivalent. Cash equivalent are simply short-term, highly liquid investments. First of all, start with this. They are short-term, highly liquid investments. That means the investments that are highly liquid, that they can be easily converted to cash easily and in the short term. But also we say that are readily convertible to known amount of cash. You know, they are short term, they can be converted to cash in the short term, but to known amount of cash, it explains the certainty of the amount of cash that I will receive, and which are subject to an insignificant risk of changes in value. Subject to insignificant risk of changes in value. That means we say, oh, if in 1 month's time or in 2 months' time, I could receive $100 million. That is, we say cash equivalent, as long as it is subjected to an insignificant risk of changes in value. That means even if there are some changes, those changes won't be material. All right, now in an exam, how do you figure out that this is a cash equivalent or not? We say an investment's maturity date of cash equivalent should normally be within 3 months from the acquisition date. So in case you have investment that does not exceed 3 months maturity, we call it cash equivalent. This is a very, very important point to note, because when preparing the statement of cash flows, you would have a line of cash and cash equivalent, and we usually combine them, right? All right, so we can proceed here. Now this is cash flows. We are told about cash flows. What are cash flows? Cash flows are simple inflows and outflows of cash and cash equivalents. Inflows and outflows. If you say inflows, cash comes into the entity. In outflows, cash goes out of the entity. Right? As you said, we'll be having three major activities, which are operating activities here, and then we'll be having investing activities as well as financing activities. So these are the three major activities that we'll be having. Now, what of the operating activities? What do we mean by operating activities? We just say that these are the principal revenue producing activities of the entity and other activities that are not investing or financing activities. So it's something very obvious that, let's say you're doing a business of selling shoes, the money obtained from selling, the revenue, the cash obtained from selling shoes actually will be in operating activities. But also you put everything as long as it is not in investing or financing activities. So the main issue here is to know what investing activities include and financing activities include. So investing activities involves acquisition and disposal of non-current assets, as well as other investments not included in the cash equivalents. So as long as there is any investment not included in the cash equivalent, this will be under investing activities. So in your exam, just be very careful. Have I acquired a non-current asset? Have I disposed a non-current asset? If you have acquired, you take a look at the cash you have obtained. If you have disposed, if you have acquired, you take a look at the cash you have given out. If you have disposed, you take a look at the cash you have received. Just like that, and all is done. And lastly, we are at the financing activities. Financing activities just result in changes in the size and the composition of the equity capital and the borrowings of the entity. Simply speaking, it affects the capital structure of the entity. Size and the composition of equity and the borrowings, or simply speaking, it results in the changes in the capital structure of the entity. So as long as you alter the capital structure of the entity, which in the statement of financial position will be seen under equity and liabilities, most probably non-current liabilities. That's where the financing activities would be. Investing activities has spoken of non-current assets. So as long as you find non-current asset there, it will be investing activities. So it's something very important to note here. Anyway, I could just go and show you the example here. Just before doing anything, I just need you to understand what we are doing. This is the question, and this is the financial position. So tangible non-current assets up to investment in non-current assets. This one will give you the investing activities, cash from investing activities. And as for financing activities, you would go to equity and the liabilities. So you'd have ordinary share capital, revaluation surplus, retained earnings, debentures. This one is tax, so it would go to tax, obviously. So this is what would constitute financing activities. So let's go back to our explanations and finish up with this introduction. So what do we do when presenting the statement of cash flows? When presenting the statement of cash flows, as I just told you, we will show three major activities that are operating activities, investing, and financing, as I just defined them at the top there. So let's proceed. We say that the manner of presentation of cash flows between operating, investing, and financing activities depends on the nature of the entity. Actually, it really depends on the nature of the entity, because there are entities that are, let's say, financial institutions, they earn interest, but interest is part of their revenue. So it really depends on the situation. And so, as I told you, we separate operating activities, investing, as well as financing activities. If doing that, what does it help you? You know, when you say operating activities, let's say the entity has generated 100 million, but in investing, it has used the 60 million net. And in financing, it has also been financed. So you just have to ask yourself, for the entity to be healthy, it should have a highly positive cash flows from operating activities, meaning that it is capable of generating cash. even if the net cash flows for the period are negative, but it showed that operating activities were much higher, were of a very high value. It gives us hope. Maybe it could be negative because at start we needed to be financed, and the need for finance actually, or maybe we paid a lot of funds to the finance providers, or maybe we invested a lot in non-current assets a lot, which gave us a net negative cash flows. But if cash flows is operating cash flows are positive, that's very fine for the entity, because you could have invested in non-current assets at very much large amounts, but those non-current assets would be used for a lot more years. So something like that. So we say by classifying cash flows between different activities in this way, users can see the impact of cash and cash equivalents of each one and their relationships with each other. Actually, we'll see this when solving questions, so don't worry at all as for now. So let's finish up. Note here, movements between different types of cash and cash equivalents are not included in cash flows. Actually, this is a very, very important point to note here. We usually aggregate the cash and the cash equivalents. We combine them. Let's say you have cash, you have bank overdraft, we have investments which are to be realized in less than, in not more than 3 months. We just combine them. So no need to show how cash moved, how cash equivalents moved. No need to show that at all. And so we say, why? The investment in surplus cash in the cash equivalents is part of a cash management. So separating them would be cash management, not statement of cash flows. So we say it's not part of operating, investing, and financing activities. That's why it's for cash and cash equivalents, we just aggregate them. And now it's time to take a deeper look into operating activities, investing activities, as well as financing activities. So let's end up here and just go to the next part, take a look at operating activities. Thank you very much for being together.